Welcome back to Lipstick Index, where we take the big scary money ideas and make them tiny. Last time, we saw what happens when a government prints too much money. The coins kept multiplying, but the apples didn't. And we learned the real secret. Money is a shared belief. Today, something that sounds terrifying, but is actually very simple once you see it clearly: the stock market. What it is, why it moves every single minute, and why knowing this changes how you think about your money. Let's start here. Imagine you open a bakery. It does well, but to grow, to open a second location, you need more money than you have. So you make a deal with 10 friends. You split the bakery into 100 equal pieces. You sell 50 of those pieces to your friends, 10 pieces each. Each piece is called a share. Your friends are now shareholders. They own a slice of your bakery. If the bakery does well, their slice is worth more. If the bakery struggles, their slice is worth less. They didn't lend you money. They bought a small piece of your business. That is a stock, a share of a real company, a small ownership stake in something that earns. Now imagine thousands of bakeries and factories and tech companies and banks, all of them split into tiny pieces, all those pieces available to buy and sell. The stock market is simply the place where those pieces are bought and sold, a marketplace, not a casino, a marketplace. Just like a fruit market where the price of apples changes based on supply and demand, the stock market prices change based on how many people want to buy or sell each piece. Here's the part that confuses everyone. Why does the price of a company change every single minute? The company didn't change. The bakery is still baking, because the price isn't the company. The price is what people believe the company is worth right now. And belief changes. A news headline, a better-than-expected earnings report, a new competitor, an interest rate move. Remember episode 4? When borrowing gets expensive, companies earn less, so their shares are worth less. Belief shifts, price shifts. Not because the bakery stopped baking, because the story around the bakery changed. This is important. The stock price is not reality. It is the current best guess about the future. Here's where it gets interesting. Over short periods, the stock market is unpredictable. It reacts to news, to emotion, to rumors, to fear. It goes up and down and sideways, sometimes for no clear reason. Trying to guess what it will do tomorrow is very hard. Even professional investors, people who do this full time, are often wrong. But over long periods, something different happens. Historically, the stock market, taken as a whole, has gone up. Not every year. Some years it falls. But over decades, the direction has been upward because companies overall keep growing. People keep buying things. Technology keeps improving. And the companies that make those things capture that growth. So the stock market over 10 years looks very different than the stock market over 10 days. Remember episode 2? The jar of coins under the bed quietly melting. Inflation shrinking your money while you weren't looking. The stock market is one of the tools people use to try to stay ahead of that melting, not a guarantee, not risk-free, but historically one of the most effective tools available. You don't need to pick individual stocks. You don't need to watch prices every minute. There are ways to buy a small piece of the whole market at once. We'll get into those. For now, the key idea: the stock market is not a place for gamblers. It's a place where ownership is bought and sold. And small, steady ownership, held through the ups and downs, has historically grown. Next time, we'll look at one specific tool that makes this accessible to almost anyone. It's called an index fund. And it's the thing that changed how ordinary people invest. If this made one big idea feel a little smaller, give it a like and follow along. I'll see you next time. Educational content, not financial advice.